Welcome to Spring Into ETF Investing. On today's special episodes, our panel of guest speakers will be discussing ETFs to help you manage risk in the current environment and a place to park cash, ETFs versus GICs.
Welcome to Spring Into ETF Investing, a special edition of ETF Market Insights. I'm Erin, VP of Online Distribution with BMO ETFs. Quick reminder that today we're not providing you any investment advice or recommendations. Our channel is all about providing education around investing and around ETFs, focused on the Canadian do-it-yourself investor. I'm going to turn it over to our special guest, Cornell Schreiber, in just a moment. Cornell is the host of the Build Wealth Canada podcast and founder of the Canadian Financial Summit, which is a free virtual conference focused on education around investing and personal finance. Cornell, I'll turn it over to you.
Welcome to ETF Market Insights. I'm Cornell Schreiber, and in this episode, we will be discussing market volatility and ways you can use ETFs to help mitigate that volatility or smooth the rise. I'm pleased to be joined by Om Karmalkar, VP and Portfolio Manager at BMO ETFs. Om is focused on equity derivatives-based and multi-asset portfolios at BMO. I'm also joined by Cam Gill, Managing Director of Market Making and Canadian Delta One Trading at CIBC Capital Markets. In his role, he's responsible for institutional sales, market making, and risk managing across all ETF asset classes. His team plays an integral role in the launch of new ETFs and support of existing ETF products. Om, can you walk us through the volatility in the markets right now and what investors are experiencing?
Yeah, first, thanks for having me here, Cornell. I would say there is a lot of headwind and volatility currently in the market, but to get a better understanding of what's causing it, I think we just need to go back to last year. So 2022 was a very tough year for investors. It was a very tough year for majority of asset classes. We saw Bank of Canada, US federal banks, and across the globe, we saw central banks raise rates at the fastest pace in recent history. And that was to combat inflation, which was, again, at very high levels that we haven't seen in decades. Because of this pace of rate hikes that we saw equity market valuations take a hit. We saw, particularly growth equities take a big hit. Moving to Europe, we saw kind of geopolitical tensions there where Russia versus Ukraine war was happening. And because of that, it aggravated an already delicate, I would say, supply chain issue that was already present due to, COVID-19. And because of that, we saw further inflation. Fast forward to 2023, all those economic concerns that were there in 2022 kind of spilled over into 2023. So we still have high interest rates. We still have geopolitical tensions going on. And further, we still have high inflation. Yes, inflation has come down from the peak. However, I would say that, it's still well above the federal bank's mandate of about, 2%. In terms of, what kind of environment investors are in, I would say investors are in a new macro and new market regime. As investors and global economy, they were very used to this low interest rate or, zero policy interest rate policies, before 2022. And because of that, we saw, when markets or when Feds started raising rates at the pace, we saw a big shift in market regime, which caught the market off guard. So I would say, investors need to be a bit more cautious and, prudent in terms of their investing and looking for quality or more dividend-based companies in this environment.
Cam, what can investors expect for the rest of the year, and what are some of the risk factors that they should be considering?
Great. Well, first of all, thanks for having us. I think this year is a very interesting one. At the beginning of the year, we saw central banks increasing rates in order to slow down the economy. But that's obviously had some consequences. In particular, the U.S. banking system issues that we've seen. It's been a bit of a concern. Now, that being said, I think that there are some pretty positive things on the horizon. Like we've seen labor markets be very strong. GDP numbers are fairly good as well. Even the Canadian housing market seems to be okay. But with the collapse of SVB, I think that central bankers have now kind of revised their approach a little bit. So they've slowed down on interest rate hikes. And I think for the most part, markets believe that interest rates will be headed lower, and that's all positive for the marketplace. I think what we've seen earlier in this year were increasing rates and higher equity markets, which is typically not the case. And with this kind of change in policy from bankers, I think that we're going to see that relationship come back. I think in addition to that, there are some pretty significant concerns on the horizon, or risks that we need to manage for: geopolitical risk, energy prices, as well as just general sentiment. I think that markets are driven by sentiment pretty heavily, and to the extent that investors feel that this is a risky environment, I think it could kind of drive the market to a lower place. So I think in general, I would expect equity markets to continue to go higher, but we need to keep those risks in sight. And to the extent that things get negative there, I'd probably consider investors to reevaluate.
Thank you. I know low volatility is a strategy that investors can use to help mitigate some of the swings in their portfolio when the market is this turbulent. Can you walk us through this type of investing or this type of strategy?
Yeah, for sure. So low volatility is a form of factor investing. The way the strategy works is it's an equity strategy that invests or tends to invest in low risk stocks versus high risk stocks. To give you an example, let's look at ZLB, which is the BMO Canadian Low Volatility ETF. The strategy invests in companies such as Loblaws or Hydro One, which tend to be less risky compared to some companies that might be in the mining industry. So like junior gold miners, which tend to be much more volatile. So, the strategy's main goal is to reduce your drawdown when markets are coming down. So it invests in strong blue chip companies, invests in companies that have strong financial balance sheets. And these companies tend to be in more defensive sectors, such as consumer staples and utilities. And like I said, the main goal is to minimize drawdown during market downturns. So for every percent or every dollar that you do save when markets are going down, it's an extra dollar that you have when markets start to recover. So you have that extra equity that the strategy is participating in when markets are recovering. So, in a good way to summarize, the low vol strategy is you win by not losing.
Mm-hmm. Now, typically, as an investor, we hear that if we want a higher expected return, we also need to take on more risk. So with this type of strategy, are we potentially limiting some of our return because we're trying to decrease that risk?
That's a great question. So I think the statement of, investors need to take higher risks to earn higher returns can be a bit misleading. And, I'll give you an example. Let's take the TSX, right? And we can break down the TSX into 4 buckets. Let's say there's the dividend growers and dividend payers. So these are companies that are either growing their dividends on an annual basis and, or paying them on an annual basis. There's your non-dividend payer companies. And then the last bucket would be your dividend cutters. So these are companies that are actually cutting their dividends. And if you look at these 4 buckets over a 30-year period, you'll see that the total return that you achieve from the dividend paying companies and the dividend growing companies is much higher compared to their counterparts. And now I know the next question is, what about risk? So even if you look at kind of the volatility of these companies, they tend to be lower versus their counterparts. So if you kind of take a step back and we kind of look at it from a high level, it's not really a big surprise. Why? These companies that are paying dividends and they're growing their dividends, these companies tend to be companies that have strong financial balance sheets. These companies tend to be leaders in their industries. So therefore, when markets are going down, these companies tend to have a much stronger balance sheet compared to some other companies. So they don't need to go and borrow money during these market turmoils. Again, I'm not saying that these strategies will outperform in every single market cycle. There will be times where, for example, low volatility strategies would underperform the broad market. So if you look at 2020, 2020 was recovering out of 2020. We saw interest rates at almost 0%. We saw a very risk-on rally. So we did see strategies, these defensive strategies lag the broad market. However, for investors who are investing for the medium to long term, these strategies are great as they provide great risk-adjusted returns over that time period.
Awesome, thank you. And Cam, switching things over to you, what should investors consider when they're reviewing the different low volatility options out there?
Sure. So, I think from a volatility perspective, the categories that most investors lean into are diversification, which is probably the most popular way to kind of manage for volatility. The second is avoiding or limiting securities that have high volatility, and that's similar to ZLP or ZLU. These products do that. The third is cash, which is a very popular option, but obviously that comes with some consequence in terms of performance in the long run. And then lastly, there are products or wrappers or structures that people can adopt to kind of limit volatility. And that can include ETFs or different portfolio construction. The other, thought as it relates to options available to investors is the type of strategies or products that are available as it relates to portfolio volatility minimization. So there's min vol, and then there is low vol. And these are kind of two ways of constructing products. Min vol is really at the portfolio level, and low vol is really almost top down as it relates to securities. And both, have benefits. I think that the BMO team has had a great run with their approach.
Mm-hmm. And what other factors can investors consider to help limit the volatility of their portfolios?
Well, so I think quality and dividends are probably two ways that stand out. Limiting yourself or focusing on product securities that have high dividends or consistent dividends is a great way to kind of lean into securities that are likely to provide low volatility. And it's just the nature of these companies, right? So if a company is consistently providing a high dividend yield, it really does speak to their business model. That means that they've got consistent cash flow. They've probably got a solid long-term business where they feel comfortable that they're able to pay cash out to investors. And that in turn will mean that they'll likely have consistent performance. And as we know, once companies start paying dividends, they're very unlikely to reduce dividends. They're very unlikely to remove dividends. And that kind of allows investors to gravitate towards these securities. So dividends is one, and then quality is the other. And to a certain extent, they go hand in hand. A company that is deemed to be high quality or blue chip, as you mentioned earlier, is more likely to produce dividends and have stable earnings. And that in turn will provide lower volatility.
Mm-hmm. And how can investors use these factor ETFs in a portfolio? And then how do you even go about building a portfolio using these?
Yeah, so investors have access to a lot of factors in the ETF market space now. As Cam mentioned, there are ETFs where you can isolate some of these factors. So there's low volatility, there's dividend, there's quality ETFs. In terms of, I would say the first step in terms of constructing a portfolio would be to take a step back and investors asking the question, what is my time horizon or investment horizon, and what are my investment goals? And based on that, you can decide on what factors might be the best for your portfolio. To give you an example, for a client in this environment who is conservative or risk averse, a low vol ETF might be a right fit for their portfolio, given the current environment we're in. And another thing I would like to say is, volatility. This is not the first time I think markets have seen volatility. Probably won't be the last time it'll see volatility. We recovered out of 2008. We saw volatility during Brexit. We saw volatility during COVID, right? So the main message here is that investors should stick to their investment plan, which might be medium to long term, and not get caught up in this short-term volatility or day-to-day volatility. Second thing I would say is, another way to use these factors when you're constructing portfolios by combining them. To give you a very simple example, if you look at ZLU, which is the BMO US Low Volatility ETF, and let's just say for simple math, 50% invested in that ETF and 50% invested in ZNQ, which is the BMO NASDAQ Index ETF. By combining this low vol factor with the growth factor, you're able to create a much more diversified portfolio, which not only beats the broad market in the medium term, but also produces a much better risk-adjusted return. So it produces higher returns without taking on higher risk. So, investors have these tools available to them. And finally, it's very important that investors have a strategic mindset when they're constructing a portfolio. It's all about hitting their goals and not getting caught up in the day-to-day volatility of these markets.
All right, thank you. And a question for both of you. Are there any other things that we can do to help limit the volatility within our portfolios?
Yeah, for sure. I can start and I can pass it to Cam after. Sure. So I would say the first one is diversification. I think many people have already said it. Diversification is a free lunch in investments. And in my previous answer, I was talking about combining different factors to create that diversification. And what I mean by diversification is, when one part of your portfolio is working, that's a great thing. But what happens when other parts are not working? You need something to step up. So that's why having diversification is very important. And diversification doesn't need to be just within factors. They can be within asset classes as well. So you can have an equity portion, asset, fixed income, and also commodities or real assets. So that's one way investors can achieve lower risk within their portfolio by diversifying it. Another one I would say is on the covered call strategies. So these are strategies that are dividend focused. And then they use option strategy on top to generate enhanced income for clients. So this strategy is great for clients who are looking for two things, one or three things actually. One is income on a monthly basis. Second, I would say, is for participating in the equity market without taking on excessive risk. And third is, because there's a call option that's written to generate that enhanced income, these strategies tend to have about 10 to 15% lower volatility versus the broad market. So these are, two ways that investors can incorporate these strategies or diversification to help lower their overall risk. I don't know if
I think, you said all the good ones. So, from my perspective, I think it's leveraging the tools that are available to you. And there's definitely a lot of innovation as it relates to product, and people are continuously finding different ways to maybe extract a little bit more return while achieving lower volatility. I think one thing that the general investor tends to miss is staying invested and choosing the right product. So understand what you want, understand what your investment objective is, and then stick to the product. I think too often within the investor community, people are constantly trying to flip out of one thing into the other and trying to achieve returns. But what they don't realize is that actually injects a ton of volatility into their own portfolio. So relying on advisors or on asset managers that produce good product is kind of the key. And then just staying the path. So I think that's one thing that I'd probably add.
All right, well, thank you for the great insights, Kim and Om. It was wonderful, and really thank you for helping investors understand how they can add exposure to their portfolios that will help smoothen the ride or lower volatility. This is so important given recent markets and can really help investors stay the course in their investment portfolios. So that caps things off for our session. I wanted to give a big thank you to BMO ETFs for continuing to host these educational segments for DIY investors and helping them become better, more informed investors. Have a great day.
I'm going to turn it over to our special guest host for today's session, Pat Boland. Pat is the host of the Just Word podcast, which covers topics within finance, investing, and much more. He's also a television personality and expert host. Happy to have you, Pat. Take it away.
Welcome to ETF Market Insights. I'm Pat Boland. In this episode, we will be discussing the recent shift to cash by investors. Why are they doing this? And what should investors consider when looking to add to a cash position in their portfolio? What are their options? GICs, HISAs, ETFs. And I'm joined by Matt Montemurro. He's the Director, Portfolio Manager with BMO ETFs, responsible for fixed income ETFs. And Jonathan Chevreau, a veteran financial journalist who has worked for the National Post and the Globe and Mail. He's also CFO of the Findependence Hub, a go-to source of information for education for Canadian investors. Thanks very much, gentlemen, for joining me. Let's start with you, Matt, first, because why have investors moved to cash so much, or cash-like alternatives, and then how much has actually moved?
So 2022 was a challenging year for all asset classes. It was only the third time in 150 years that we saw both stocks and bonds have negative calendar year returns. So to avoid that volatility, we saw a lot of investors move to the sidelines, take their money out of the market, and try to wait until some of the risks subsided. And at the same time, we saw the Bank of Canada raise rates from 25 basis points to 450 basis points in a single year. So not only were they taking risk out of the market, they were getting paid to do so. And we've seen as we've moved into 2023, we've seen investors say, you know what, I'm getting paid to sit in cash, take very little to no risk, and I'm getting paid 4 to 5% yield for it. So, that migration has continued. In terms of how much have we seen, those ETFs now amass 20 billion in size. That's 10x growth that we've seen over the last 2 or 3 years. April alone brought in 4 billion of short-term and money market ETF flows. So it's definitely a trade that we're seeing investors continue to take advantage of. Look at the yield curve and say, 5% for very little risk. It's a winning trade in a lot of cases.
Okay, so Jonathan, what are the different places you can park cash?
Well, I mean, looking at 2 years ago, it was cash is trash, if you remember. And what was the other thing? Tina. There was no alternative stocks, which is pretty stressful if, like myself, and a lot of people who read what I write about, because I write a retired money column, retirees are pretty frustrated having to take risks that they didn't really want to take. And now, as Matt points out, if you can get 4 or 5%, where you basically got zero on a bank account until about 18 months ago. Now, of course, the GIC is back. In America, they call it the CD, or certificate deposit. In Canada, the guaranteed investment certificate pays, last I checked, about 4.5%. It'll vary by about 50 basis points, depending on whether you're going 1 or 5 years. It's not a big, huge difference right now. In fact, the yield curve is inverted. So in the old days, the 5-year GIC would pay better. You'd be paid for locking your money away for 5 years relative to a 1 year. Right now it's inverted, so a 1 year GIC pays better. So that's one place, I think, and maybe we'll talk about that a little bit more. The second one, you mentioned already, the HISA, or high interest savings account, or money market ETFs. These are, unlike GICs, you can basically park them day by day. And if you need the money, ideally for an emergency, or you want to buy a house, you take advantage of the first home savings account, for example, and get a down payment. You don't know whether you're going to find a property in 6 months, a year, or tomorrow, in which case a HISA paying 2.5–3%, Matt can tell me the exact amount, would be a valuable alternative. And then thirdly, there's short-term bond ETFs, or bond ETFs, not necessarily short-term. Until in the last couple of years, when people thought rates were going to start going higher, people kind of gravitated to the short-term and shorter-term bond ETFs to prevent the duration problems that actually did materialize. Why do we have a big problem right now with all these U.S. banks and regionals? They lost a lot of money on long-term bonds.
Okay, so let's break it down a little bit, Matt. The difference between HISAs, ETFs, short-term, I guess money market ETFs as well.
So the big difference is it's fundamental in what you are investing in. So let's start with the HISA ETFs. You are literally investing or depositing in a portfolio of high interest savings accounts. So these accounts are offered by many different banks, and they generally offer a higher than normal yield to incentivize deposits. So these ETFs will gather a portfolio of these and pass and flow through that yield to investors. Looking at short-term fixed income or money market, you're looking at a more traditional bond-like portfolio. So you're investing in securities like Canadian T-bills, provincial T-bills, short-term corporate bonds, federal bonds, bankers' acceptance notes, commercial paper. So this is a more traditional fixed income portfolio where a borrower will look to pay a certain yield, and the investor will achieve that yield in a very short time period, so very little duration risk. Both products offer a very similar yield, but fundamentally what they actually invest in, or what they have in the funds, is fundamentally different.
So Jonathan, what should you consider before you make a decision on the route that you take?
Well, number one is, what do you need the money for, and when do you need it? So if most people need an emergency fund. So the rule of thumb has been you should have 6 months of your salary tucked away in case you lose your job and your boss gets annoyed at you. You can keep the lights on and the water bills and all the rest of it paid until you find a new job. On the other extreme, you're saving for retirement. You have a 30-year time horizon. You probably don't want to be in a money market fund, because if right now the rate of inflation is higher than what you're getting on, even though 4.5% sounds pretty good, if it's 6% inflation, which we've been up to close to, then you're actually losing relative to inflation. So then liquidity is to me a big concern. There's not that much difference right now in the yield between, for example, the 5-year GIC and a 1-year GIC. In fact, because the yield curve is inverted, the 1-year GIC actually pays better than a 5-year GIC. So you might say, well, then why would I want to lock my money up and not have access to it for 5 years? Well, the reason is we're not sure that interest rates are going to keep on going higher. Maybe they've just sort of stabilized. And in fact, what if they came down again? Then your retiree that's so happy about having 5% on a risk-free investment may say, gee, I shouldn't have put it in that 1-year GIC for just 25 basis extra. I should have kept my powder dry, and or I should have done the opposite. I should have extended out to 5 years. So now that interest rates have come down again, like what if you're back into ZIRP, zero interest rate policy again by the central banks? Then you'll wish you had gone to the 5-year GIC.
Yeah, it's a catch-22. You touched on liquidity, and so Matt, why use an ETF?
So, we've seen that migration into a lot of ETFs, and I think it's that intraday liquidity, that flexibility that it gives investors. It allows you, like Jonathan said, you don't have to time the market. You don't have to expect, I'm going to buy a house in 6 months from now, or I'm going to buy a house in a year from now, and you can avoid all those lockup periods that kind of plague the GIC investment and kind of worry investors. So, that flexibility of the ETF allowing you intraday liquidity, allowing you to pivot and redeploy your cash, whether you need to spend it on a big expenditure or redeploy it into the equity market, because maybe there's an opportunity that you see and you want to move it from cash back into equities on a risk-on like trade. So, the ETF provides flexibility for investors, transparency. You can see it trading on the exchange. You have transparency in terms of price, and it gives you a lot of different options. You have CAD options, USD. You have the type. We just talked about HISA versus money market. You have a lot of options that give you the exact exposure you may need for that cash allocation, and it's very transparent and predictable.
Every investment, though, has some degree of risk. Not very much in cash or cash-like alternatives, Jonathan, but what are some of the considerations of risk?
Well, I personally like the asset allocation ETFs, which basically take away all the problem. As Matt said in his introduction, like 2022 was an unusual year that even balanced funds, including balanced ETFs, were down. I haven't looked at the figures lately, but I would think that ironically, the more conservative balanced ETFs, and if you had the ones which were 80% fixed income, and the investor was thinking that was going to be the most risk-free, they'd actually get the rude awakening that they lost more because of the bonds were down. That if you look at your portfolio, you're going, oh, I was saved because gold was up, or certain equity sectors were up, and the stocks ironically were hit less than the bond portion of the portfolio. But I think over the long run, the classic pension fund portfolio of 60-40, 60% stocks, 40% bonds, whether that's a pension fund or an asset allocation ETF, or even a balanced mutual fund, they should hold investors pretty safe in the long run.
In light of what Jonathan just said then, Matt, what do you have to consider when you're looking at these cash alternatives as far as risk is concerned, and throw in tax as well?
Absolutely. So let's start with the risk side of the coin. You're looking at lockup periods. That's something to consider. You don't want to lock away your capital for too long. And if you do, if the market changes, if opportunities come, if your money is locked up, you may not be able to take advantage of those opportunities. So that's something to consider when looking at a GIC that may have a longer than a 6-month, 12-month, 18-month lockup period. That's something to consider. The second is, although cash pays 4 to 5%, Jonathan mentioned before that inflation we're at 4% now, but it was 6% earlier this year. You need to make sure that what you're earning is keeping up with inflation. So that real rate of return. And so that's something to consider in a high interest rate, high inflation environment. We haven't seen that in quite some time. So that's something, one of the other considerations. And then from a tax perspective, tax is unique. On fixed income, if you're a taxable investor, it's important to be tax aware. The distribution yield or the coupon is what you get taxed at as income. So for a HISA or a GIC, that top line yield, that 5% yield, let's call it, gets taxed as income. Short-term fixed income you also get that distribution yield, but there's a unique anomaly in the market right now. Because last year had such a challenging year for returns, most fixed income, most bonds are trading at a discount to par, meaning that their price is lower than $100. So what that means is that distribution yield, that coupon, tends to be lower. So let's call it 3%. And the yield to maturity is 5%. So you're getting taxed as income on the 3, and you get a capital gain to the 5. And on an after-tax basis, you could add 50 to 100 basis points to your return by just making that consideration and looking into that decision when looking to invest your cash. So, it's important for taxable investors to be tax aware and to understand how your investments are going to be taxed at the end of the year.
Okay, Jonathan, so how should people actually use these cash alternatives in constructing their portfolios?
Well, we discussed the cash portion of the asset allocation ETFs last time. Personally, I think that the inflation bonds is an interesting topic. People say, well, gee, what happened to real return bonds? Well, the Canadian government actually has suspended that program, but the pension funds in Canada are quite annoyed because it was a perfect way to match their liabilities for long-term pensioners. Fortunately, you can buy TIPS. In the States, they still have them. They're called Treasury Inflation Protected Securities. And in fact, BMO has, what's the name of that fund?
Two different ETFs, ZTIP and TIPS. So
which I owned. So that seems like the best of all worlds. I would hope that somebody would be lobbying the government of Canada to reintroduce real return bonds, because you've got to hedge those ones because they're in US dollars, and you're fixing one risk at the expense of another one. You're introducing some currency risk. So yes, the BMO TIPS product is kind of gets around that by hedging back into the Canadian dollar. And as you said, there's also a US dollar version.
Correct.
Okay, so all of this is against the background of the environment, the fixed income environment. Matt, just summarize what's going on right now.
Yeah, absolutely. So, 2022, tough year all around, but I think there's a lot of opportunity in fixed income as we move forward in 2023. The Bank of Canada has set to pause their interest rate hiking policy. So we're likely at a peak in rates in Canada at about 4.5% overnight rate. The Fed this week just raised by another 25 basis points. They haven't explicitly said that they are pausing, but the market firmly expects that, hike in May and go away, and we expect that to be the pause. So what I see going forward is I think we're going to get stability in our interest rate policy right now. We're going to likely hit a peak in interest rates. But as I look forward, I'm the view we're going to be in a higher rate for longer. And the reason I say we're going to see higher rates for longer is that I think it takes a lot of time for interest rate hikes to make their way through the system, 18 to 24 months. And I think we've made meaningful progress in reducing inflation from 6 to 4%. But I think that 4 to 2% to get to the Bank of Canada's target, that's going to be the stubborn, sticky inflation that's going to take the 18 to 24 months to really start to make a dent. So, although I think some pundits are saying that we're going to see cuts this year, I think we're going to be in a higher interest rate environment for longer. I think we're going to get stability. So I think there is opportunity in the bond market. I think looking at, like we were talking about, these cash ETFs that are yielding 5% in the short end, that's a perfect example of investors being able to take advantage of the market and say, okay, I can take very little interest rate risk, little interest rate sensitivity risk by way of duration, and still achieve a 5% yield. That's very attractive. That's something we haven't seen since the mid 2000s. So, I think investors need to consider the market right now. I think be happy that we're entering a more stable environment, but also expect we're not going to necessarily go back down to zero, just at the end of this year. So I think that's something for investors to tackle with. I think we are in a very positive environment for bonds. So, if I was looking forward, I think bond investors should be very happy with returns this year. And I think I favor the short end of the curve in terms of credit exposure, and then complementing that with some long duration exposure, because if we do expect higher rates for longer, we're likely going to see an economic slowdown, an equity market pullback, and that long duration exposure will help be the ballast of your portfolio at the end of the day.
Matt, Jonathan, thank you so much for your insights.
Thanks, Pat.
And I hope this gives investors some ideas around what they should be considering when evaluating the different cash options that are out there and why it's important to maintain diversification in your portfolio. I want to thank BMO ETFs for continuing these educational segments for investors, helping them become better and more informed. Have a great day.